Joining us right now is Komal Sri-Kumar. He's the president, of course, of Sri-Kumar Global Strategies. Sri, it's great to see you this morning.
Good to be back.
I said it at the top of the show, and I wasn't trying to make excuses. Joe, I think was suggesting I might be, but is this a situation where you can't fight the Fed anymore? I mean, between the Fed yesterday and this remdesivir news yesterday, the market just keeps moving higher and higher.
Let's start with the Fed first, Andrew. Yes, in the short term, you cannot fight the Fed. By my estimation, they have already added about 50% of the GDP, $11 trillion out of $22 trillion, as their stimulus so far. So that is having an effect on the liquidity and on investor sentiment. As for the medical side of it, even if you have a vaccine tomorrow, and we had a discussion earlier in this program about how long it would take with Dr. Gottlieb in terms of having an impact on it. I think the positive impact on the economy is going to take quite some time, not only the second quarter that Chairman Powell talked about, the third, fourth quarters are likely to be difficult as well. None of those is figured into equity prices, and that is my concern in terms of looking at what the investor should be doing at this time.
So explain what you mean by that. You don't believe that the second half of this year is being factored properly in terms of the demand picture? Is that what you're trying to say?
That's exactly right. I think the demand is going to fall off. Aggregate demand for consumption, demand for investment goods are going to fall off much more than investors have given it credit for. Once that is taken into account, I think the equities have a second leg down. And I don't think this is going to be any different, Andrew, than what we saw in the final quarter of 2008 and not bottoming out until the March of 2009. We have a rally, which to me still seems like a bear market rally. One more piece of evidence. As you know, I've been saying on your program repeatedly that you should look at the Treasury yields even more than the equity in terms of where the markets are headed, where the economy is headed. And right now, what you have is a 10-year yield, which is stubbornly in the neighborhood of 60 basis points, and it refuses to go up, even as the equity markets have. We hit a high recently of 78 basis points, but we have come back. The bond market is giving a much more negative message than the equities are.
Hey, Sri, you once called for sub 1 on the 10-year. Do you see negative rates in the future?
Andrew, I would at this time only say that the 10-year yield can go close to zero, beating the March 9th low that we had of 31 basis points. And I can also see the federal funds rate going negative. In the last few days, we have lingered very close to zero. So we are not too far away from going negative at all. So I think the zero for the 10-year and negative for the federal funds rate are both, I think, very much should be things investors should be considering.
So, Sri, as you were bearish, as you were bullish on bonds and bearish on rates, I mean, the S&P moved to 3,400, and you were, below sub 1%, whatever. So, I mean, it's fine to say that, wow, that the stock market's wrong, the bond market's right, but I mean, people can trade from 2,200 to 3,400. That's like a 50% move, Sri. So I think bond guys should really stick with bond. And a lot of them, if you go back to the financial crisis, every bond guy, none of them ever got bullish in 2008 or 2009. Now, you might be right now, and 60 basis points is frightening. And there's a lot of things that are frightening about the entire global economy and demand and everything else. But the S&P, I looked at it yesterday, it was 2940 again. The bears in the stock market were down before the pandemic. We're at 2,400 and 2,500. So in the midst of the pandemic, we're off the highs of 3,400, but we're back to almost 2,940. So that's either one hell of a bear market rally, or the bond market isn't the harbinger of the stock market. One or the other.
I would say to you, it is neither, Joe. I think what you have is, this is not trading advice that I'm providing. I'm talking about where the markets are suggesting, what they are suggesting about the economy and where we are headed.
So the stock market could stay divorced from the economy because of the Fed and because of the central bankers, I guess. Is that what you're saying? The stock market doesn't necessarily have to reflect the underlying global economy. That's certainly
precisely. And you've just in a matter of a few weeks, yes, you have moved up substantially, and it has been a trader's market. But that's not the job of the Fed. It should not be fostering speculation, which I think is essentially what it is doing. And I'm saying that in the matter of months, the economy is going to dominate over the Fed, and the long-term holders are going to dominate over the traders. That is the message in short that I'm trying to provide here.